Well, it is April, so that's time for our first quarter 2025 update. And sadly, the first quarter was a pretty decent quarter. It had some bumpy rides in it, but it is actually the second quarter of 2025 that's got rather interesting. And we're going to touch on both. But I want to kind of go back and review what happened in the first quarter, and then we'll talk about Trump and we'll talk about tariffs. So I'm just going to share my screen here. All right, so let's start looking through the numbers here. So the first quarter, which obviously runs January 1st to March 31st, was an interesting quarter because both the Canadian and US stock markets made all-time highs during the quarter. And as the month of March stretched on, a lot of those gains started to evaporate. But at the end of the first quarter, our Canadian market was up just under 1%, 0.8%. The S&P 500 was down 4.6. The Dow down 1.3. We often don't talk a lot about the Dow simply because it represents 30 stocks. It's not a great benchmark to compare to the US stock market. However, it is on the news, so we thought we'd share it. The tech-heavy NASDAQ was down 10.4%, and the Russell 2000, which focuses a little bit more on the small cap companies, was down just under 10. And as Jack and I were kind of going back at the end of the quarter and we were reviewing client assets, we were feeling pretty comfortable with where things were. On a rough calculation, client assets at the end of the quarter were approximately 1% higher than we started the year at. So for the average client, that means they had a very small gain, maybe a small loss, but had, relatively ended the quarter flat, and that to us was pretty significant given the drawdown in the US markets. Part of what, led to those client returns is largely we've tried to be roughly a third in Canada, predominantly for currency, overweight Canada by that definition, since Canada represents 3% of the global stock market. That means 97% of the other opportunities trade in a currency other than Canadian dollars. So that's more about currency than what we necessarily expected from stock performance. The US stock market represents anywhere from, depending on your point of measurement, roughly 60 to 70% at times of the global stock market. And we've tried to have roughly a third of client money in the US. So we are underweight the US stock market, and the remaining third would fall to international. And so if you look further down this chart, international stocks were off to a pretty good start. The UK, France, Germany all had gains. Japan had gains earlier in the month, but gave those up. The emerging market index was up 2.1%, and Europe as a whole was up 6.1%. And because the US represents a large portion of the world index showed down 3% in the quarter. And, when we're reviewing this and kind of looking at clients, we felt we were in pretty good shape. It also, to kind of be flat given this environment, we were quite happy to play a little bit of defense here. Obviously, with what's happening in early in the second quarter, things have changed a little bit. But before we get to that, we want to kind of move forward and, kind of look at where are we now in the cycle? What was happening in the first quarter in terms of economic data? So we'll kind of walk through that now. The S&P 500 index was trading at about 20.2 times earnings at the end of the quarter, which is down from its peak. Next slide shows it a little bit better. And so, as you know, we've followed the S&P 500 index and largely have broken out the top 10 stocks, because those top 10 stocks at the peak represented almost 40% of the index, meaning the other 490 stocks that are part of the S&P 500 index represented the other 65%. And as you can see over here, we're starting to see that fade a little bit. And that's largely become, if we come over here, this is the performance of those 10 stocks that make up the index. They are massive, and they have moved the indice as a whole And at the end of the quarter, they were trading at 24 and a half times earnings roughly, when their long-term average, is about 20.5%. So trading at a bit of a premium. Well, the other 490 stocks in the index were trading at 18.3% compared to their long-term average of 15, almost 16%. So as you can see, the market as a whole, in the US was trading at a bit of a premium in terms of what their long-term price earnings ratios are. The Mag 7 has been, very significant in terms of performance, but it was starting to wane. This is why the tech-heavy NASDAQ is down more than the S&P 500, because those 7 stocks have a much larger weighting in the NASDAQ stock market. And you can see in 23, that basket, the Mag 7, returned 76%, another 48% last year. But the first quarter of this year, they were down 14.8%, where the rest of the US stock market at the end of the quarter actually had, those other 490 stocks actually had a small gain of 0.4%. But because those 10 stocks have such a large weighting in the index, they actually had dragged the S&P 500 down by 4.6%. We've talked about the S&P 500, we've talked about the US market, and we've talked about the Mag 7 before. We were getting a little bit concerned about, the richness of the valuations in those stocks. And so, although we do have some exposure to them, we are significantly underweight the Magnificent 7 stocks. And as we were looking forward, prior to Trump and his tariffs, the market actually wasn't looking that bad. There was looking for some earnings expansion in terms of what the future expectations of earnings were of those companies, to grow by roughly 11% in 2025, grow by 14% in 26, and possibly another 12% in 2027. And that was largely going to come from, an increase in margins, an increase in revenue, and a little bit to do with share count. Obviously, with tariffs, that is going to put a lot of pressure on margins and potentially revenue as well. So that's a bit concerning as we move forward. Valuations, when we talk about the S&P 500 index, again, we've looked at value versus growth, and value stocks at the end of the quarter were still, trading below their long-term average, but had moved up over the quarter. You see that here. Again, when you look at international securities, they've always historically traded at a discount to the US. Back in the financial crisis, they actually traded a bit of a premium. But as the US has done so well, the performance of the US stock market has been so strong in the last decade, valuations of international stocks have continued to drift, drift lower. But we saw in the first quarter this year kind of a reversal of that. So there was some strength in international markets. Again, looking at, some trends going on, you look at Japan had been doing quite well, and look at Europe here. There's a significant spike up in terms of performance versus the S&P 500. We were starting to see a divergence of the markets where international securities were starting to significantly outperform their US counterparts. And prior to what was going on, the consumer's balance sheet in the US actually was pretty solid, where they had roughly $190 trillion in assets compared to liabilities of 20 trillion. The debt service ratio was starting to creep up with higher rates. But at the same time, even though the balance sheet was strong for the average US consumer confidence in the US started to drop off considerably. And, if we were to update this chart today, it would be even lower than where it is out here. And part of what's going on in the US really has a lot to do with, their spending, and they're spending out of control. Their federal budget for 2025 is $7 trillion, but they're short, really $2 trillion. They are spending $2 trillion more a year than they are taking in. And when you look over here to the right, these little red bars, that's what the future deficit looks like if the Republican Party and Trump extend the tax cuts. And that's what's concerning the market and, about rising debt levels in the US. The Republican Party and Trump seem to think that tariffs will make up that shortfall and they'll be able to um, extend those tax cuts. And it's certainly, in my opinion, flawed thinking on that part. And now this chart really shows you the history of tariffs, the average tariff rate on US goods and imports for consumption. This was the shocker. If you kind of move down here, tariffs have kind of moved up a little bit, over the last few years from a very low level. The expectation, the estimate at the end of the quarter that we would see a significant spike in tariff rates south of the border, but somewhere south of 8%. Maybe when it all, balanced out, that's what the market was looking for. As we all know, they came in much higher than what was anticipated. And that's what's shaken the market. And you can see, moving from 2 to 8% is almost 4 times. Now we've got a level that's even higher than that going forward. International markets, there was starting to be some divergence with what was going on with NATO. Germany was doing exceptionally well, so was Europe. Like, look at this spike in aerospace and defense spending. International banks were starting to pick up. Taiwan technology had started to wane as it might come back to the US, but this is the US growth right here, so falling off considerably. When we get this kind of market volatility, it's a good reminder, if you look at a short-term time horizon of 1 year in this example, there's your range of possible outcomes. Anything in terms of stocks, which is the green, anything from a loss of 37% in any given year to a gain of 52% in any given year, and whatever in between. But as you can see, as you look over an extended period of time, the probability of losses decreases significantly in the market. Again, a quick snapshot. Whatever crisis we're in at the point in time always feels like the biggest crisis. We haven't had a crisis like this before. We've never come across this before. This chart is littered with reasons not to be an investor or a reason to sell. And through all that uncertainty over the last, 15, 20 years, we've seen almost it all in terms of different things that can happen, the volatility of the market, reasons to be concerned. Markets, statistically, when we look at stocks, on average, very simplistically, stocks spend 2/3 of their time going up and 1/3 of their time going down. If you look at the little yellow drawdowns, those are bear markets. And bear markets can be big, they can be impactful, but very seldom do they ever last a long time. And that's what's really important. The blue is bull markets, periods of rising stocks, and they tend to last a lot longer than bear markets. We're also, philosophically talk about, the current bull market, and maybe we break this bull market, but historically, on average, a bull market lasts somewhere between 4.5 and 5 years. The current bull market that we're in, which is, maybe up for debate what happens here over the next few days, is that, year one, which started in October of 2022, the return was a little bit less than what the average was. That's typically the performance of the average bull market year one. However, year two is, when we look back, the performance, so from October of 23 to October of 24, actually significantly outpaced what the normal averages would be in the second year. And net, it was kind of pretty standard as to where we should be after 2 years in the bull market. Year three is always the crummy year. And, this chart's slightly dated. We would see this red line below it here. But we actually started out a little bit better than what, the average bull market in year three is. It tends to be a very small gain, sometimes a mild loss. So we're in that choppiness typically anyways, regardless of what's going on with markets and Trump. Year three tends to be a little bit more volatile and less satisfying. With a lot going on, this is a very interesting chart in my mind, given that you've got two political parties south of the border and the extreme divergence in how they see the economy going, depending on who is in power. And as you can see that there's a rise here in the Republican Party. This is going back to 1980, and a lot of people are surprised by this, but every year at some point in time, you go back over the last 45 years, the markets have been negative at some point in time. And interesting enough, the average, you go back over that 45 years, the average drawdown, the intra-year drop from kind of top to bottom, averages 14.1%, which is pretty significant over the course of a year. However, even after all that, the markets were positive 34 out of the 45 years. So that kind of brings us to where we are today. If you look back in the first quarter, it really, economically, it was really not a weak quarter. It was a pretty strong quarter. It was a pretty average quarter. But now what's happened is tariffs have been introduced, and the scale and scope of tariffs being introduced to the US has been much more significant than what was anticipated, and obviously retaliatory tariffs are expected to follow. So this is as of the close of business in terms of April 4th, this past Friday. The Canadian market now in 2025 is down 6.2%. The S&P 500 is down 13. The Dow's down almost 10. The Nasdaq's down 19.3. Excuse me. And this is a reminder, this is not from the peak. This is from the start of the year. And the Russell down 18. And what we've seen is, by and large, those international stocks have given up some of their gains. So the UK is now down, France is now down, Germany's showing a small gain. Japan has given up a little bit more. Emerging markets, it's eked out a small gain still. Europe as a whole is up roughly 1%, and the US has dragged the world index down 11.4%. And so, Jack and I had been reviewing, client assets, kind of where we stand at, now that we've had this downturn. And look, we're pretty happy with the way we're positioned, again, being roughly a third in Canada, a third in the US, and a third international. At the end of April 4th, the close of business, we reviewed it on the weekend. Client assets as a whole were down kind of 6 to 7% on average over the course of the first quarter, plus those first 4 days into April, and down roughly 9 to 10% from the peak. So as a whole, we've been holding our own. We're not being, client assets are not drawn down to the same degree as what the market is. Not to discount the experience for you as an investor. A drawdown of 6 to 7% or 9 to 10% from the peak is quite honestly a garden variety correction in the big picture. We're not in the double digits of 20% like the Nasdaq, 23% from the high. So we're playing a defense here reasonably well. Yes, we're getting caught up in the drawdown, but not as deep as what's been going on globally. This is a very interesting chart. There are two human emotions that get in the way of every good business decision. One is fear, the other is greed. And Warren Buffett said at one time, we should be greedy when others are fearful, and we should be fearful when others are greedy. Having been in the business over 30 years, quite honestly, I've never seen this indexed at 4 ever. It is lower than what it was during COVID and the economic, global shutdown that we experienced. It has been extreme fear for roughly a week, but a month ago it was at 17. A week ago it was at 19. It's currently at 4. And if we look back a year ago, it was just, on the opposite side of neutral, just into the greed at 58. So that's what's driving markets right now. That's what investor sentiment is very fearful. People are making panic decisions. We're not of the opinion that this is the environment to make big or rational decisions, because more often than not, you would expect that fear is driving the decision today. And that's not a good place to be, just like it's not when it's a greedy environment. So what do we do as we go forward? You know, right now, when we're looking big picture, so a correction is when stocks decline, 10% or more. We get into what's called bear market territory if they decline over 20% from their high. So right now, the NASDAQ is down 20% from its high. Even though Germany has a gain still, they're down 20% from high. That just tells you how well their market was doing earlier this year. And Japan is now down over 20% from its high. That tells us that there's a significant amount of bad news that has already been priced in the market. The market was playing catch up with Trump's tariff policy. Now, we don't think we're out of it yet. We think that, that we're going to expect a lot more volatility throughout the spring, possibly even into the summer. But what we're afraid of is changes in policy that could quickly halt or even reverse some of the damage that the markets received here early in April. And on Monday, April 7th, that was a very good indication of what could happen and how we could get whipsawed around. And I'm not looking for, a quick recovery back to the all-time highs, but I think the gap could close. And so on the morning of April 7th, the Monday following the two-day drawdown, the opening indication, the futures for the US stock market, were trading negative somewhere in the range of a roughly 6% was the expected open of the US market to open 6% lower. By the time 9:30 rolled around in North America, the markets were down, kind of 3.5% to 4%. And later in the morning, there was a rumor that started to circulate that, there's a possibility that, Trump could pause the tariffs for 90 days. And those markets, the US markets, actually went to be up 2% on the day. So remember, we're starting opening indication of down 6% to being up 2%, all in the same morning. That's a swing of 8 percentage points, which is significant, which is massive. Obviously later on, what came out was that, it was if there was going to be a reprieve of tariffs for 90 days, it would exclude China. And then next thing you know, it's false news and the markets went back down. But that is, a concern and something to think about as we move forward. It's one thing to plan for today under today's environment, but we don't know what the rules of the game are going to be tomorrow. And so that's partly why we believe that people should be sitting on their hands, kind of riding through this, because last thing you want to do is reposition your portfolio for what you think today is the reality, only to find out tomorrow it's a new reality. And kind of as we go forward, there are some signs of hope. In my mind, we're starting to see, some discourse amongst Republicans, on Capitol Hill are worrying about this. The market drawdown could cost them the Senate and the House in the midterms in 2026. I think there will be some negotiation with Trump. They will start to negotiate. It might not be easy, it might not be quick, but I do think there will start to be some negotiating going on to pull these tariffs back. Then we look at the possibility of stimulus. And this one I'm really unsure of. Earlier this year, there was the expectation that the US would receive 4 interest rate cuts, which would stimulate the economy. However, that being said, the longer these tariffs stay in place, the less likely I think that will happen, because that will be inflationary. And to cut rates in an inflationary environment would basically fan the flames and make the economy a little bit hotter, which could have inflation go higher. And we've been talking a lot about how inflationary this could be. I'm just possibly wondering out loud the effects of deflation and what is possibly the likelihood that we have a bunch of reluctant consumers that sit on their pocketbooks, that don't open their wallets or purses, and don't make any significant purchases. And, as far-fetched as that might seem, look at what's happening with the price of oil. we're starting to see oil, come down and be under $60. And although I think recession risks are rising in the US, if we go back and that's why I want to take some of the slides that we looked at in the first quarter of the year, economic data was still pretty reasonable and still pretty strong. And it would be unusual to see the US have a recession at 4% unemployment with possible stimulus through interest rate cuts. So bottom line, these are kind of what we're thinking is, look, these trade wars are probably going to persist for many more months. I think the closer you get to the midterm elections, the likelihood is the Republicans are going to want to see the economy and markets doing better due to the risk of re-election. Eventually, the market runs out of sellers. It just, this downturn has been swift. And for someone who's worked in the industry for 30 years, as difficult as this may be to understand, if we're going to have a downturn in the market, quite honestly, this is how I like it. I would far rather have, a 20% correction over a few days, be down and dirty, get it over with, and let's move on from there. The last thing I'd like to see is a decline of 5%, each year for 4 consecutive years to be down 20%, 4 years later. I really think, down and dirty, let's fix it, let's move on and build it from there. And I think Republicans are, if they're not already, there's certainly not a long lineup, but there is some resistance to it. Republicans within their own party telling Trump he should wrap up the trade war with his tariffs. And look, we've got an election, that is not that far out, that will come up pretty quickly. And the Republicans are looking vulnerable and they're concerned about that. So, our advice to you is to sit pat, ride through it as difficult it would be. I know emotionally with the headlines in the newspaper, I'm a client too, also your advisor, but it's important to, recognize that there is a certain level of fear today where maybe it had been, greedy before. By all means, you have any questions or concerns, please reach out to Jack and I. We'd be happy to talk to you, walk you through what's going on. It is your money. It is ultimately your decision what you want to do with your money, and we'll do our best to make sure that we guide you through the process. Take care and thanks for watching.